So we do a lot of agency performance audits, a lot. And when we do agency performance audits, we look at people are calling us because something's not working. Not working the way they think it should be working, or there's a lot of pain in certain areas. And so what we do is we actually look at them and we say, okay, let's look at their people. Let's look at your roles and responsibilities. Let's look at your workflows from new business, from your ideal engagements, if you even have them defined, all the way through to how you execute on those and how you manage a project and how you, all the way to billing and closing that project. So we go through that whole process with people. And what I wanted to do is share a huge portion of that is obviously financial, and we drill into Workology and figure out what people are doing. And what I wanted to do is share with you the top sort of findings that we have that people, that we sort of give recommendations back to people in their audits of what they might be doing incorrectly. So I figured this would be a good topic to share with everybody. Some of these things you may have completely nailed down and doing them right. Some of you may have a few of these things, one or two of these things, but I think it's really good for everybody to know. So number one, I kind of hinted at this yesterday, and I think this is really important. You didn't buy Workology to replicate your previous accounting technology and your old PM ways and your old PM tools. However, a lot of people, they buy Workology and they think that the minimum is that, well, at least it's all in one place. Like that's, hey, it's all in one tool. But you're not actually using the tool the way the tool needs to be used. You just replicated your old bad habits and your old technologies and you brought them into Workology. Okay? Shame on you. Don't do that. And a lot of people do that because they want to get it up quickly, right? They want to get into Workology quickly. But to be honest, fixing it all once it's in Workology is not as easy as if you were to just take the time to do it right the first time, right? So this is an ERP system, guys. This is an SAP or an Oracle for the creative services industry, okay? And you shouldn't think of it as less than that. Okay? It means that what we want is we want to have our transactions, labor, our purchase items, our expense items. We want to have all of that transactional data should drive the general ledger data. Okay? And I say this and people kind of look at me and go, well, mine does. Yeah, I just analyze my data and then I manually recognize revenue. I'm going, no. That's a disconnecting of the system. What you want is you want all of that data. I want to be able to say, what was the feeling on the floor last month? To what does my operational reporting data say? To what does my financials say? And the holes in those are going to be the areas I need to dig into. But if I'm not using gap matching, and so my statements are all over the place, and if I am not even using transactions, I'm just analyzing, and if I have this lovely manual whip spreadsheet with tons of journal entries, I can guarantee you that your system is not really connected. Okay? So what you need to do is figure out how you're actually going to connect that system, because that is the value. You want to drill into all that data. You want all the data to answer all the questions that you have about running the business. The only way you're going to do that is if that system is completely connected, right? I'm not creating manual invoices. I'm using transactions to recognize revenue. Okay? So, and we're going to talk a lot more about that later. But it's really important to note, like, this is the baseline of where you need to start. If you're not here, you need to get here with the technology. Imagine as an accountant, if everything was connected, I would have I think of how many sub ledgers I now have all the way down to the bottom, because I know exactly what I use to produce all of that revenue, all those COGS, all that AGI, everything. Okay? You have so much information at your fingertips if you do it that way. If you continue to use it separated, you're going to continue to have the same problems you had in the old systems in Workology. Number 2, let's talk about this. Okay, we're not matching. So this is a big thing for agencies. We need to be running our financials. We need to be running our agency off of accrual-based financials. Whether you file taxes cash basis or not, for better taxing, that's fine. But at the end of the day, you need to be running your business on accrual-based financials. And in order to do that, you also can't be recognizing revenue on billings, okay? So there's a lot of agencies that are still recognizing revenue on billings, okay? Now, if I'm a time and materials agency and I progress bill and I date my invoice on the 31st of every single month, then yes, my invoices and revenue recognition are completely matched, okay? But for most people, there's so many different ways of that, and what happens is, because they're not necessarily using some of the more advanced tools in Workology, they're not getting good matching. So their revenue and their costs are not aligned. So I have big swings in my financial statements. And so when I go in to analyze them, I don't know if it's just a swing or if it's real. And so what I end up having to do is, all the analysis I do has to be 6 months or greater in order to even get a little bit of insight. So I can't even look at 1 month of financials and pull out any insights and actually be sure of it. So that's one of those things that, again, it's really, really important. And I know that it's the last thing you're thinking about, because you're thinking about getting work out the door and you're thinking about all these things to really elevate those financial processes. But you really need to do that to make sure. You need to be matching that. And the same thing with your labor and your direct labor costs. So I should be recognizing the revenue based on percent complete as I go through this project, right? Because that's going to be the best matching to my direct labor, assuming your contracts are there. But you can talk to Renee about ASC 606 for next year. She knows all about it. So, but you need to make sure you're matching that. Don't be over-recognizing revenue in the wrong periods based on your labor costs, right? So again, it's not just expense matching, but it's actually the labor income that you're taking and making sure that's aligned to your direct payroll costs, okay? So now the question is, how do we do that? And Workology has provided some really advanced accounting functionality to do that. And I can't tell you how many times we come in and do an audit and people are doing all of this manually with a whole bunch of journal entries, and it gets really messy, and there's no way it's as accurate. No way. So here's one of the first focuses of where they go sideways with this. They're not properly using advance bills, okay? So one of the things to understand in Workology is that there are 2 types of invoices in Workology, okay? There are invoices called advance bills that are considered deferred revenue, unearned revenue, okay? And then there are invoices that are considered transactional, where I pull transactions onto those invoices and I recognize revenue, okay? Totally different. You need to separate the concept that invoicing and revenue recognition are the same thing, because they are not. And for some people, they still think of them as the same thing. And for some people, like I said, if you're always invoicing actuals at the end of the month and dating it the last day of the month, then yeah, you're safe. And I know there's one agency out there that pretty much does that 100%, but I would say that is rare. Most agencies have probably, 10 to 15 forms of billing terms in which they say deposit completion, installment, deposit progress, all of the above, right? So it means that you now need to completely separate this concept, and you need to know when you're using advance bills and when you're using transactional invoices, and know that when you're using your advance bills, in order to reduce that deferred revenue, I have to take a transactional invoice and apply it. And when I do that, it reduces my deferred revenue and it categorizes my revenue. And that's when I actually get the transactionally categorized revenue at that point in time. And what we see is that people they get confused and they're not quite sure. So some people will use advance bills and then they'll use journal entries to reduce their deferred revenue instead of using transactions and applying them, so the system will automatically do that. So what have I done if I do that? I have now, my subledger doesn't try. I should have an advance bill aging report subledger I can tie at the end of every single month that basically guarantees that I have applied everything properly, and I should be looking and saying, is this revenue is still deferred? Is that a good thing or a bad thing, right? At the end of the day, well, it depends on the situation. But sometimes people have deferred revenue sitting out there for years that they forgot about, that they never took as revenue, that the client doesn't even work with them anymore, and they didn't even realize it. So again, part of your end-to-month process needs to be running that advance bill aging report and making sure that that ties. Don't ever journal into any of these system-generated accounts like your advance bill accrual, because the second you do that, again, you've messed up your subledgers and you don't have a good way to check yourself every month and make sure it's right and be reviewing these. So this is, again, deposit invoices. This is a big one. I see a lot of this where someone gives you a huge deposit for media or whatever it might be, and you're not using advance billing to ensure that that hits your deferred revenue account and then earn that money as you earn it, okay? Don't recognize it as you earn it. Don't recognize it, early, or try to recognize it manually via journal entries. All those things are wrong. Don't do those, okay? So, and a lot of times I see there's real big confusion between advance billing and pre-billing, and that terminology. You have to retrain your agency to say the right terminology. Advance billing is when I bill in advance and I don't recognize revenue, okay? Pre-billing is when I bill an order and I recognize revenue and I accrue the costs. So if your team, and I know that these words are very synonymous in the industry, but they're not once you get into Workology. Once you get into Workology, you now have to retrain your team to be thinking about these things differently. And they have to stop saying pre-bill when they mean advance bill and stop saying advance bill or whatever when they mean pre-bill. You've got to make sure that that gets clear, because it really, the consequences are big to doing it wrong. Okay? So not using Workology whip functionality. Ron, don't kill me, because I'm going to tell everybody eventually you want to get here. But Ron's right, you don't want to get here until you know what you're doing, okay? Because this could we talk about the goal of gap matching. If you mismanage WIP, you can have worse financial statements than if you don't use it at all, okay? So I'm not going to tell you that it's, I'm not going to tell you that there isn't some risk to it, but the reality is if you use Workology's WIP properly, and if you're doing things properly, you will have much better financial statements, okay? So let's talk about why you want to use WIP. Okay, just said, much better financial statements, but why? So what WIP allows you to do is, so imagine I'm an agency that has, that I have some type of billing terms, deposit and completion, right? So I can deposit invoice and I can recognize that revenue. So let's say I have a $100,000 project and I deposit bill $50,000 in month one. So it's currently my advance bill, and at the end of that month I review my transactions, but I have, let's just say I have $70,000 in transactions, and they're all valid transactions. I'm completely on budget. But I can't, if I were to create a transactional invoice for $70,000 and apply it to my advance bill, I would have open AR that isn't AR, right? Because I would only be able to apply $50,000 to that. So, but if my billing terms aren't that I don't get to bill to the very end, then I have this extra $20,000 I've earned, but I can't recognize it as revenue. I can't attach it to my advance bill. So what am I going to do? Well, I'm going to use WIP, because WIP is going to accrue revenue on your labor transactions that you have earned. Okay? However, let's imagine that take that same project and I did $70,000 worth of work and nobody's watching the project, nobody's writing anything off, and I'm now $20,000 over budget. So I'm really only 50% of the way through the project, but I have that extra $20,000 in the project and nobody's actually looked at it. because maybe I don't have project managers. Kidding. Not kidding. So right, it happens, right? Because we don't, most account managers, they look at it at the end of the project. But we have to look at it in the middle. So what happens with WIP, so the risk of WIP, is that I didn't look at that project, I didn't write that $20,000 off, and I posted WIP, and now I accrued $20,000 more in my financial statements than I should have. There's your risk. So in order for WIP to be safe to use, your project managers must be doing transaction review. They must be looking at budget and transaction review and recommending write-offs. You can't just write off at the end of the project. You have to write off as you go through the project. And if you have good project architecture and task and service estimates that say my concepting phase was supposed to be 10,000 or 15,000 and it's 20, if I don't have that information, I'm kind of guessing at that percent complete, where is that? But if I have good project architecture with good task and service estimates, it's the best revenue recognition I could have. I completed discovery. It's supposed to be $15,000. It's $15,000 in transactions. Perfect. I don't have to write anything off. I'm good. So I can use Workology, I can use the project management side of Workology to help me have better revenue recognition and therefore better financial statements. So if you don't have PMs looking at it, if you're not doing write-offs every single month, then you're going to over-recognize revenue in the wrong periods, often, and then that's going to reverse out in a future period, right? So now I'm going to have even worse financial swings than if I didn't use that. Okay, so again, that's the really important piece, and so if we talk about that's WIP for labor, right? Because it's accruing the cost. So I've earned it, but I haven't billed it, right? That's what I'm doing with labor. Okay, let's talk about WIP for expenses. So this is another big matching, right? Let's talk about reimbursable expenses is a good one. So you guys often have reimbursable travel, reimbursable expenses, things you pay for in advance. For a lot of big production and big media, often you're advance billing, which means you're getting the cash in early for that and it's less of an issue. However, for reimbursables, you usually go on site, travel, spend all this money, and then eventually once all the travel costs are in, 3 months later, thanks to our account people and creative directors. Kidding, sort of. Right? So 3 months later, I can finally build these reimbursables back, right? But remember, when I purchased those things, okay, it actually hit my cost of goods sold at that time, right? But I don't want it to hit them because it's not matching, right? I don't want it to hit there, and then eventually I get my reimbursable revenue 3 or 4 months later, right? Okay? I want them to match. So Workology, if I have an expense that's in a billable project, when I post WIP, it will defer that expense. It will pull that out of COGS and it'll put it on your balance sheet to say, hey, this is an asset. You are going to bill this later. You're going to get paid for it later. So I'm going to leave it here, remind you that it's an asset. And then when you actually bill it out later, I'm going to move it back and I'm going to match it for you. Isn't that beautiful? It's a great thing, right? So we got to let Workology do that for us. Let them manage those costs. And that could just be, and it's not just reimbursable. Sometimes you have to pay for things before your client is going to pay you back. It's not an ideal scenario, but every agency does it. So you need to make sure before you can bill it that you can actually, the system will defer that cost. Otherwise, again, you're looking at your financials and you're seeing these swings and you don't know if it's just because you had these extra expenses in this month that didn't necessarily get matched properly. Okay? So again, using WIP for labor and using WIP for expenses is it's absolutely critical to having good financials. Now, keep in mind, WIP might be more or less material for your agency. So for example, let's use that agency that does time and materials billing at the end of progress bill at the end of every single month, dated at the end of the month. that agency probably WIP is not very material. Now, it might be for expenses, but for labor, it probably isn't. But if you do that, then WIP's not going to be a big deal. But if you're heavily project-based and you have large deposit and completion terms or anything like that, or projects that are extended over a long period of time, WIP probably is going to have a material effect on your financials, in which case you absolutely want to be using WIP. Don't go home and just turn it on, okay? Because all those support people over there will kill me if you do that, right, Penny? Yeah. So don't do that. You need to know what you're doing with WIP, okay? And you need to understand, and you need project management to be reviewing transactions, and you should be having your revenue recognition meetings, which we're going to talk about later, because in those revenue recognition meetings, finance, PM, accounting, they're all looking at the budget, they're ensuring, they're looking at that project architecture, they're double checking that the data that's there is not going to mess up their financials. They're determining what's going to go to WIP, what's going to get categorized as transactional revenue, and at the end of the day, you're making sure that that's going to be good before you actually go. So by the time you post that WIP button, you're not really worried about it. Okay? So you have to ask yourself, are you ready for WIP? And if you don't have a strong project management discipline, the answer is no. You need to have a strong, if you're not reviewing transactions every single month. You don't have to be having a RevRec meeting in order to post WIP, but you have to have good communication between project management and accounting, and you must be writing off transactions every month. Okay? If you're only writing them off at the end of the project, you risk over-recognizing revenue and having these large swings in your revenue as they reverse out in future periods. Okay? So another really, really, really important thing. Okay, what's the other one? Pre-bill accrual. So people, yeah, this one gets really messy. So difference between advanced billing and pre-bill, and I said it earlier, advanced billing is how you manage deferred or unearned revenue. I bill something in advance, I check the advanced bill box, and if your system's set up properly, it guarantees that that does not go to revenue, that goes to your deferred revenue or your advanced bill accrual liability account on the balance sheet. And it stays there. So then, from there, you need to, so that's your advanced billing, and then you recognize your revenue. Pre-billing. So a lot of people use this with, how many people here use pre-billing with media? Oh, good, a few of you. Okay, right. This is where I see this the most, but there are a lot of good places to use billing. Pre-billing is literally when I pull an order, IOBO purchase order, when I pull an order onto a transactional invoice, right, and I post that invoice, I have now recognized the revenue, that gross amount. I recognize the revenue on that the day that I post it, and it automatically accrues the cost. Because guess what? I don't have a vendor invoice, do I? So again, another piece of matching, right? If I need to recognize revenue on something and I don't have a vendor invoice, I use an order. And I attach the order to the transactional invoice. I take the revenue and it accrues the cost until the vendor invoice comes in. When the vendor invoice comes in, I apply that properly and it relieves it, okay? So it's simple, it makes sense, except that this is where a lot of people make a lot of mistakes. Number one, when you're pre-billing for media, don't use pre-bill when you should use advance bill. If you're billing the month before the media runs, you shouldn't be using a pre-bill. If you're billing 3 months before the media runs, don't use a pre-bill because it recognizes the revenue, and you should be recognizing the revenue in the month the media runs, or the expense, whatever it is. Recognize that revenue in the month that happens. And if you use pre-bill early, then you're recognizing revenue in the wrong period. Now, yes, it's accruing the cost, but it's not in the right period. So you need to make sure that you're advanced billing. So if you're billing media, most people, so a lot of people You bill media the first of the month. If you have good enough terms, right, then you get paid before you have to pay your vendor invoices. And then you can pre-bill on the first of every month for the IOs that are running in that month. However, for a lot of people that don't have those terms, they've got to bill a month to 2 months in advance for media. The second you do that, you don't pre-bill anymore. I mean, you do, but you advance bill first. Then in the month the media runs, you pre-bill, apply them, and then you reconcile your vendor invoices after that. Unfortunately, advance billing early to do it right adds an entire another reconciliation to your media process. Because now I have to reconcile what I advance billed to what I pre-billed, and then what I pre-billed to my vendor invoices. Okay? But that's how you do it right. So if you can get away and you can set your terms to pre-bill on the first of the month that the media runs, that is the most efficient media process that you can do without stiffing your vendors, obviously, because we don't want to do that either. But when that's not possible, you need to be using a combination of advance bill and pre-bill, and then reconciling those vendor invoices. Okay? So that's media, but let's talk a little bit about production, right? Or the other big one is contract labor. I don't know if anybody here does purchase orders for contract labor, but that's another big one where you usually want to recognize the revenue on that contract labor before the contractor sends you a vendor invoice. And if that's the case, then you want to make sure that you are pulling that purchase order onto your transactional invoice. And what's nice about the billing worksheets is you can choose to include or not include all the different types of orders. So I would highly recommend doing that and basically making sure that it's going to recognize the revenue and it's going to accrue the expense. Now, the place where people go really wrong with pre-bill, besides the recognizing revenue in the wrong period, is when they apply vendor invoices, okay? So when you apply your vendor invoice, well, first of all, you really need to have a good, solid vendor invoice reconciliation process, in which case, so obviously a media reconciliation process is slightly different just because of the complexity of it than I would say a general vendor invoice reconciliation process. If it's a vendor invoice reconciliation process, the vendor invoices come to accounting, they push them to the project manager. The project manager, who outsourced the work, reviews it, validates that it's right. They either update their purchase order or update the line. They add a line to that purchase order for the difference. And then they give it back to accounting. And then when accounting enters it, they know exactly what lines to, and it should match every single time. By the time accounting gets it, it should match every single time. Accounting shouldn't be messing with markups and things from that application screen of the vendor invoice to PO. It should match. Okay? And if it doesn't, then it's a process issue you need to figure out over here so that it does match. Because when accounting just applies and they're wrong, it is a disaster to clean up. And I can't tell you how many times people are applying vendor invoices to the wrong lines or in media. Renee does a lot of cleanup when people do that, because at the end of the day, what happens is, let's say it comes in under, people leave things accrued forever. I've seen things on open purchase orders that haven't been closed that have stayed accrued for 5 years on your financial statements. Not good. Not good. And then when I have to reverse it all and I say, oh, I'm sorry, you just got $200,000 more profit because I just reversed all of these, then nobody's really happy. So you want to make sure. So that's where every month you should be tying out your pre-bill accrual using your accrued order detail report. So in your AP reports, there's an accrued order detail report. You should be looking at that report every single month. And if there's something on it from January, you need to make sure it should still be on there. Now, it happens. Things are long and they take a while, or there's one per month and it's a January purchase or a January IO and it goes one per month through the end of the month, and so it's still valid for the next line. But you need to look at that, because if you apply incorrectly and or if you don't close purchase orders, then it will not reverse those accruals the way it should. And it's better to reverse those accruals as close to the time that happened, the vendor invoice comes in, as possible. That's when you want to reverse those accruals. You can't always be right. Your accruals will not be perfect, but you want to reverse it out as close to that vendor invoice as possible. So if you do it every single month, then you shouldn't have a problem with that. But you do need to remember to look at that every month. Okay. So I'm going to say ineffective or non-existent monthly billing and revenue recognition meetings. So some people are having these, but they're not asking the right questions and they're not going over the right information to make everybody successful, and or they're not doing them at all. And you know, I work with a lot of people, and there's a lot of concerns. I was actually talking to somebody about this yesterday at the table, and they said, my God, that sounds like it would take forever. And the reality is, in the beginning, it does. In the beginning, it is a very long process. We do a lot of these, and we facilitate a lot of these monthly billing and revenue recognition meetings. And in the beginning, it's an education process, because what I find is your project managers and account managers are missing a lot of the financial the financial understandings and concepts that they need really to effectively do their job. They don't really know how an agency makes money. They don't really know how we should bill and what we should do. And so because of that, your first 3 to 4 months of revenue recognition meetings are literally like monthly training sessions. But once you get them there, they go really fast. And you can take your revenue recognition meetings down by over 75% in 3 to 4 months. But it just means you got to stick it out. You got to just stick it out, and you got to do them, and they will get better. But don't quit. And I will tell you that our clients probably say it's the biggest reason why they find problems and fix problems is they find them in these meetings. There are consistent themes that you learn in these meetings that you can then make operational changes to solve these things. Now, if you're not going to make the operational changes anyway, then don't waste your time. But most people say they want to. So, but the reality is, it's the monthly meeting of accountability. Like, I literally say that. You show up, and you better be prepared, or you're wasting all of our time, and I'm going to kick you out of the room. You better know your project. You better know your budgets. Because here's the thing. Even those PMs, even though they want to review their projects, they don't have time. They get so busy. But you know what they have to do every month before this meeting? They have to review where they're at in their project. They have to. So if you don't have these meetings, what happens is everything else gets in the way, and they review it at the very end of the project. Well, what can I do at the end of the project? I mean, how much can I actually affect when I looked at it at the very end? Not that much. I need to look at it in the middle. And so basically, you need to have those PMs doing that, reviewing that, and then hold them and the account people accountable for the decisions that are being made in that meeting. And the decisions that are being made is, where's our budget? If I had discovery and it was $10,000 and I'm at $20,000, shouldn't we be having a conversation? We need to write those transactions off, because accounting cannot risk over-recognizing revenue. So accounting is going to force you to write those off. Or if you say, but I'm going to get a change order, then maybe they'll put them on hold. They don't post to WIP, and we bring them back, and we recognize them. But you actually, as an operations person facilitating that meeting, as who should be facilitating that, that's where I'm saying, excuse me, Mr. Account Manager, why are you not going back for a change order? Half the time it's because they don't know how to explain it to the client. So you help them, you work with them, you teach them how to do that, and the next thing you know, they do it. Or if nothing else, you say, this can't happen again. You need to catch this ahead of time. And again, if I do have a good project management discipline that's proactive, hopefully they brought this thing up early on so we could catch it, right? So I'm telling you that if you have the right conversations in these meetings, if you discuss the right things, then you will significantly reduce that realization gap and be able to recoup that financial potential. But again, your project managers have to be well prepped. Remember, if they're doing transaction and budget management every single week, then when they get to billing prep, It's like a week's worth of transactions to review. They already know what they want to do. If they're good, they've already talked to the account person about anything that's out of scope, and they've already addressed if they're going to go back for a change order or if it was an internal mistake and we're probably going to have to eat it. They've already had these conversations because they're doing their job well. So by the time they get to the RevRec meeting, it's not that hard. Okay? Now again, the first few, they're a little rough. I will tell you that now. But once you get them trained, they don't want to show up to that meeting not prepared. And the other thing that's really great is, I'm talking about who's in the meeting, right? So your project manager is obviously in the meeting. Your account person is in the meeting. Your accounting person is in the meeting, ensuring that we are following our gap principles, right? Our gap matching. And then you should have operations facilitating that meeting, asking the right questions, saying, tell me what the SOW for this is. I can't tell you how many times I facilitate RevRec and I say, okay, what's the SOW for this project? And it takes them 15 minutes to find it, to find the right version of it. And they didn't know it. They didn't know what was included. They didn't know what was excluded. They didn't know anything about this project, but they're managing it. That's not going to go well, right? So they've got to know what the SOW, what's equal to the SOW, the project or the campaign, or these random 4 projects all added together in different places equal this SOW, right? What is equal to the SOW? What are the budgets? How do they break out? How are we doing as a percent complete across all these budgets? You have to challenge them to answer those questions. If they can't answer those questions, they're not doing a good job from a project management perspective. They may be getting work out the door and they may be getting it out on time, but they're missing the financial role of their job. And that is what I talked about yesterday that has to change in this industry. So once we have this meeting, we determine the write-offs in this meeting. We pull up all of our electronic billing worksheet. We look at the details. We actually perform our write-offs because they tell us what we need to write off. We perform the write-offs. We agree on the write-off reasons. Was it over-servicing? Was it beyond scope? Was it mis-scoping, right? We answer all of those questions in the meeting. We perform those write-offs. And we also determine if there's value add, right? What if we came under budget? Fixed bid project, $10,000, we come in under budget. What do? I add a miscellaneous cost for value add, so it's transactional. Yeah?
In general, what do you think is a normal close time frame from the 31st to maybe the 4th or the 6th to get billing done? Because then the waterfall flows after.
It kind of is and kind of isn't. There's actually 2 tracks for end of month. And you should be able to close in easily 8 business days, if not less. So what you need to do is be running different tracks. Now, there are some people who have to close faster, and if they close faster, I recommend backing up. They might have to back up their meetings, and they might have to back up their RevRec by a week potentially. So some people who report up to holding companies or other things, sometimes they're forced to close in 4 business days or things like that because their parent company gets the 8 days. So when that happens, then there are things that we work around. But there's 2 tracks to end a month. There are certain things that you must do before you start your billing and revenue recognition meetings. But once I'm done with my billing and revenue recognition, all my other things that can be done, my account reconciliations, all those things can be done on the side over here as I'm facilitating my billing meetings. So there's very minimal work I need to do after my billing meetings. And once I do go through my billing meetings and I attach all my transactional invoices to my advanced bills and I post WIP, there's not that much left to do. I need to check all of my subledgers. I need to verify that everything ties. I need to deal with prepaid, some of the other things, but most of that stuff can be done on its own track. So you can actually have 2 tracks, run them simultaneously, and still hit an 8 or less day business close. Now, but that may mean you have to run more than 1 track of billing meetings, right? So you may be running 2 tracks if you're really big, you may be running 2 tracks of billing meetings. Or even 3 tracks of billing meetings, as I have done for even your 400 plus people agencies. But once you do that, and again, like I said, I know it's painful for the first 3 months. I am not going to kid you in any way, shape, or form and say it's not. But it's like that pain when you are working out and you haven't worked out in a really long time and it's just awful, right? But you get over it, right? You keep doing and it gets better and better and better and easier. And that is how it is. And it does get better. But if you, and again, in those meetings, you add those miscellaneous costs, determine your revenue and your WIP. And then when you leave those meetings, everything's done and everything's clean. Accounting just takes the transaction. In the meeting, you already have your advanced bills. You can apply your advanced bills at your billing worksheet stage. The only thing I have to do is generate my transactional invoices, right, and post them. And I've done all my revenue recognition. I'm done. And all I got to do now is post WIP and validate WIP and make sure that I didn't get something else that was in there, like a non-billable project that became billable and wasn't supposed to be, right? There's little things you can catch in there. But that's really what you want to focus on. And again, it's really easy once you do it, a few months in advance. So let's talk about, so the last big piece is this inability to link financial data to operational activities. So we kind of hinted at this yesterday, right? That big number, right? That big number of $2 million, you have a $2 million gap. You're like, thanks, that's great. Okay, it's really big, that sucks. What am I going to do about it? If you have to be able, accounting's job is no longer just to do the numbers, and especially not in this industry, because most of the people you are trying to convince to do something different, they don't think like you in any way, shape, or form. You are not running a CPA firm. You're not running financials for a law firm. You are running financials for a creative company, and most of them do not think the way accountants think. I think accountants' biggest mistake is they can't translate their language to the language of the people they are trying to convince to change. And you have to do that. If you can't just be an accounting person and not understand operations anymore. You have to link those two. You can't just be looking at your EBITDA or your net profit and think that that's enough. You have to translate what's going wrong in the organization that is affecting those things. And you and the operations person need to be besties. And you guys need to be connected at the hip, determining, figuring out, wow, it's a utilization gap. No, it's a realization gap. No, it's a rate margin problem. How are we going to fix those? Well, here's all the things that are affecting those. Which are our biggest problems? There's too many issues you're focusing on at the same time. Find out what are the 2 or 3 things that are going to make the biggest difference in your organization, and focus on those and measure those, and get your leadership team to focus on only those things. Because if they focus on 10 things, 15 things, they won't be successful. Give them 3, no more than 3, and measure it. And measure your entire team against that over a period of time. Is my realization gap getting better? I'm measuring my write-offs. Is it getting better and better or not? So those are the things that you need to be thinking about. You need to be using write-offs. Do you have labor budgets? Do you have target utilizations, labor budgets in Workology, and target utilizations that you're looking at? Define that utilization gap. Multiply it out by the average rate of your agency so you can at least have some concept of financial potential that you're missing out. And then explain that to your principals and figure out what motivates your principals, and that's what you use. Do they want to retire? Do they want to buy a building? Do they want a boat? Think of all the things they can't have because of my utilization gap, and then literally say, gosh, you could have had 3 yachts for this realization gap. So let's talk about this. It's like I'm going to measure my financial opportunity costs in whatever they want. You could have had 3 buildings, 5 yachts, 2 helicopters. Measure it in a way that it makes sense to them, because that's how you have to translate it.